Welcome back to Alpha Recap, your quick, friendly rundown of what moved markets today. I'm so glad you're here. As always, if you have questions, you can reach us at stockalpha.ai and ask anything about today's action. We've got Kate in the studio, fixed income specialist, very pleasant, very smart. Kate, great to have you.
Thanks for having me. Excited to walk through the day.
All right, quick headline first. Markets closed down across the board. The S&P ETF finished the day down about 1.4%. The tech-heavy NASDAQ ETF was down about 1.4% as well. And small caps fell a bit more, down about 1.6%. Big move. So, what really stands out here is, why did we see that sort of synchronized sell-off?
It really came down to Fed commentary and the way investors are thinking about AI spending. Chair Powell flagged that the massive investment in AI infrastructure could be inflationary, and he said the Fed may need to keep policy higher for longer. Analysts note that those two ideas together, higher rates and big AI capex, forced a repricing, especially in long-duration tech names.
Hold on, say that again? How does more AI spending lead the Fed to be more hawkish? That feels a little counterintuitive to some listeners.
Sure, in plain terms, if companies build lots of data centers, buy specialized chips, hire engineers, that increases demand for capital goods and labor. If demand stays strong in those areas, core inflation could stay higher. The Fed watches that stuff. So the idea is that stronger AI investment could keep inflation elevated, which reduces the chances of rate cuts coming soon.
Right. And the other thing is, markets heard higher for longer and reacted fast.
Exactly. When the expected path for interest rates shifts up, that hits valuations on stocks that depend on future profits. Long-duration assets, like many growth and AI-exposed names, are the most sensitive. Higher discount rates mean lower present values for those future earnings, so multiples compress.
And we saw that play out even in firms that reported good numbers, right? Microsoft, for example, beat on results, but still finished the day lower.
Yeah, that tracks. Analysts think Microsoft's move was partly profit-taking after a strong run, and partly sensitivity to the new Fed framing around AI capex. Even high-quality names aren't immune when macro expectations shift.
Let's talk breadth and where leadership failed or held up. You mentioned small caps dropping more. Why is that important?
Small caps tend to be more sensitive to domestic growth and to liquidity. The fact that small caps, measured by that small cap ETF we watch, fell more, down about 1.6%, is a signal that risk appetite backed up beyond just high multiple tech. Breadth deteriorated, which makes any recovery harder unless you see more sectors participate.
Okay. Sector by sector, quick tour. What were today's winners and losers?
Utilities were one of the few pockets of strength. Investors moved into defensive yield, and some renewables-adjacent names did well. Technology was weak across the board. Communication services and media were mixed as people parsed who can monetize AI. Materials and industrials were mixed. Pockets tied to tech supply chains saw interest, but risk-off flows capped upside. Financials were under pressure amid crypto headwinds and uncertainty on lending trends. Energy was choppy, and crypto bounced back, which provided relief to a few fintech names.
So utilities up, tech down, small caps softer, and crypto rebounded. That's a lot to unpack. Honestly, I was a bit surprised by the crypto rebound in the same session as this Fed hawkishness.
Yeah, markets are messy. Crypto can move independently on its own news flow or positioning. A rebound there helped a handful of related equities, but it wasn't enough to offset the broader repricing driven by the Fed tone.
Let's drill into a couple of notable names. Oracle fell on concerns about revenue concentration tied to AI partners. Explain that in simple terms.
When a company's revenue depends heavily on a few customers or a big partner, investors worry about how sustainable that revenue is and how much pricing power the customer has. With Oracle, people are asking whether its AI partnerships create customer concentration risk or margin pressure. That kind of scrutiny can lead to outsized moves, even if the core business looks fine.
Weibo had a mixed print. Earnings per share of about 26 cents and revenue around $4.7 billion. That produced volatility, right?
Yes. Mixed results like that in a thin or nervous market can drive big swings. Investors are watching user metrics and monetization, especially in China, where the macro backdrop is uneven.
Quick hits. Disney announced strategic moves and restructuring. D.R. Horton stayed in focus with housing sensitivity. And microcap tech names like those in Silicon Photonics saw rumor-driven volatility. And then a few small filings from companies like Singulet and SailPoint created short, sharp moves.
Right. In thinner names, discrete news or filings can cause outsized reactions. That's normal, but it's worth calling out because it increases headline noise on an already choppy day.
Let's talk yields. What did fixed income do, and why should equity investors care?
Treasury yields reacted to Powell's remarks. The key dynamic is the front end. If two-year yields rise, it signals the market is pricing in a longer period of restrictive policy. That tends to put more pressure on growth stocks. If yields stabilize, risk assets can recover some lost ground. So watching 2-year and 10-year moves is essential in the near term.
Got it. What about historical context? Is this just a repeat of 2022?
It's similar in character, but smaller in scale. In 2022, a hawkish pivot and rising inflation expectations caused rapid multiple compression in long-duration assets. Today's move looked like a smaller version, quick to reprice as policy uncertainty increased, but it's the same mechanism at work.
Short reactions.
Right.
Wow.
Yeah.
Tactical checklist. What are you watching going into the next session?
First, Treasury yields and the 2-year, 10-year reaction to Powell and any new data. Second, follow through in tech earnings and management commentary on AI capex and customer concentration. Third, whether crypto's rebound holds. Fourth, sector flows into utilities and renewables. Are they a short-term flight to safety or a longer rotation? And finally, any regional bank commentary or macro prints that clarify credit conditions.
Quick, plain takeaways for listeners who want the bottom line.
Sure. 1. The market pulled back because Powell framed AI spending as a potential inflationary force, making a near-term easing cycle less likely. 2. The sell-off hit tech and small caps, showing this was a broader risk-off move, not just a tech problem. 3. Utilities and select materials offered respite, but breadth needs to improve for markets to regain conviction.
And one more. Keep an eye on yields. If front-end yields keep rising, that could extend the weakness in growth names.
Exactly. Analysts note that stabilization in yields would be a positive signal for risk assets, while further front-end moves higher would probably deepen the repricing.
Final quick note, this commentary is informational only. It's not personalized investment advice, and we're not recommending buying, selling, or holding any particular stock. Analysts' observations reflect market data and trends. If you have questions about anything we covered today, head to stockalpha.ai, where you can ask us directly and we'll answer live. For more market analysis and insights, visit stockalpha.ai. Thanks for listening. See you next time on Alpha Recap.